Okay. Welcome everyone to the DSC monthly webinar series, December edition. Our new monthly AI and data science dose webinar series will provide you with in-depth insights each month. We'll delve into the most current topics shaping the AI and data science landscape. I'm Yasmin Ali, Program Director at DSC MENA. I'll be your host for tonight. Today, we're excited to dive into the topic of smart finance and unleashing the power of fintech and AI. We'll discuss how AI is shaping the future of finance in the Middle East. We're thrilled to have a reputable figure with experience in the smart finance field. She's a data scientist with 5 years of experience in markets, including banking and technology. She's also a master's student with strong passion for knowledge sharing. Please help me welcome Miss Mariam Gaafar. Hi, Mariam. It's an honor to have you with us today.
Thanks, Yasmin. Okay, let me get started. Um, just 1 second. Hello, today I'll be talking about smart finance. Particularly, I'll be talking about how AI can support the financial field. I will walk you through my first day of orientation when I was working in Crédit Agricole Bank. I didn't know what a loan is, and I didn't know what are the products that are offered by the bank. So my first introduction to the work in the bank was actually understanding the financial crisis that happened in 2008, because it shaped a lot of what's happening today in the financial market. So let's start by setting some ground rules and setting like some very basic definitions, such as the loans being secured and unsecured. A secured loan is when you go to the bank, tell them, I want money for a specific mortgage, which is I want money to buy a home, or I want money to buy a car. When you do this, it's called secured, because at the end of the day, if the customer fails to pay back their loans, the bank can have the car and sell it, or it can have the mortgage and sell it. However, there are also unsecured loans, which are loans that are not necessarily going towards a mortgage or a car. It's some personal loan for something that we cannot really resell, such as, for example, if someone wants to renovate their home. So it doesn't necessarily mean that they're gonna sell their home if they're unable to pay their loans. So the financial crisis in 2008 is all about when people figured out that there are secured loans, and if they're secured by mortgages, particularly houses. So banks figured out that if they give people loans to buy houses and they put an interest on that, there it's a win-win situation. Whereas the bank, if you pay your loans back, the bank gains the money, and if you don't pay your loans back, the bank sells the house and they still have their money back. So the banks figured that out in 2007, and they found that this is a very profitable type of loans to be having. So they started offering mortgages to borrowers regardless of their background. So if you go today to any bank and ask them to open a loan, they're gonna do some questionnaire or ask about you and your salary and ask you for proofs to prove that you are eligible to take a loan and capable of paying it back. In 2007, 2008, the banks did not do that because it added more delays, and the banks were competing into giving those mortgage loans to the customer. So they favored being quick and being like collecting more customers than focusing on the type of customers they're collecting. So that resulted in the customers, or people with very poor credit history, having house or mortgage loans. Additionally, banks were allowed to lend anybody. So right now, banks are obliged to not lend specific people who have, for example, disputes with the government. But back in 2007, the banks were allowed to give money to anybody. And also, there was very low risk, or low risk analysis. So the banks were paying a lot of money to the customers to give them mortgage loans, and the basically there is no risk analysis. They didn't know whether the customers will pay back or not. Naturally, this resulted in a catastrophe. Basically, when banks gave loans to a lot of people, like think of hundreds of thousands of people who have mortgage loans that they're unable to pay back, at some point in 2008, everyone wanted to sell their homes. And when everyone wanted to sell their homes, the prices of houses significantly decreased, which means that it no longer covered the amount that the bank initially gave. So remember what we said, that the housing loan was a secure loan because people were able to um, sell, or the banks were able to sell the houses and get their money back. But when they tried to sell all the houses together, the housing bubble occurred, and everyone, they couldn't get back they couldn't sell it at the price, the high price, because there was many people who are selling their homes and there was very low demand, which meant that there is a housing bubble. Also, this resulted in banks having a huge gap in their commitments in what they paid as compared to what they are getting back from selling the houses. So the banks lost a lot of money, and many banks were actually went bankrupt because of that. And the banks that did not go bankrupt costed the government a lot of money, because costed the government a lot of money, because the government or the people were basically trying to bail out those banks that have a lot of money to pay to the banks, to the government. Okay, so, what did we learn from this financial crisis? That we need to manage the risk. It's okay to give loans. Loans are risky because you give money and you're not sure if this money will get back or not. And it is a mathematical game. So, you give nine people a certain amount of money. You're pretty sure that two people out of the nine will not pay. So, you try to put an interest rate where the remaining eight people can cover the people who don't pay, and make it profitable as well. So this is the game of the risk management game, understanding the risks that you have, and also understanding, like, how to make up for people who will not be able to pay their loans, and how to identify them. If you suddenly give loans to 10 people and all 10 people fail to pay back the loans, you'll definitely go bankrupt. So this is the risk management aspect that I'm talking about, that the banks needed to invest more in. So they needed to do accurate risk assessment and all in order to understand who to give loans to. So why do we need machine learning in finance? This is the particular reason we need it for. Risk management, basically understanding the probability. Machine learning is all about predicting what's gonna happen and understanding the probability of certain outcomes. So, with machine learning, we can able to detect the risks, detect people who will not be able to pay back their loans, which is called default. Default is not being able to pay back your loans. And also, we can, like, identify anomalies. If all of a sudden someone is paying a huge amount of money, this is an anomaly, and this could suggest fishy behavior. So machine learning can be done in that. Also, we have predictive analytics, or predictive algorithms, such as loan default, stock market movement. So machine learning can predict the movement of stock market properly. and consumer spending patterns. So it may be entirely helpful to understand what people are spending their money on so that you give them promotions, you give them better packages, and you suggest the best products for them. So there are two types of machine learning: supervised machine learning and unsupervised machine learning. For supervised machine learning, it's basically a type of machine learning where the model is trained on a label data set. So we have the history of the data and we have a label that exists on historical data. And what we're trying to do is that we basically are trying to use to learn from the history to predict the future. And for the an example of a supervised machine learning problem is fraud detection, where we classify customers as fraudulent or not fraudulent. A fraudulent customer in the financial domain will be a customer who takes, for example, another person's credit card and uses it, or a person who withdraws a wrong amount from your card when you go try to pay with your card. So there are plenty of fraudulent transactions. So they have patterns in them. So for example, if I have a customer who normally pays around 200 and all of a sudden this customer pays thousands and thousands of pounds, this could be um, a fraudulent transaction, and being able to detect that with machine learning saves your money as a customer and saves the bank's money, because sometimes the bank actually has to make up for your lost money. So this is an example of supervised learning, which is fraud detection. We have history of fraudulent and not fraudulent transaction, and what we're trying to do is see in the future what are fraudulent and non-fraudulent transactions. Oh, sorry, just 1 second. I'm sorry, I'm back. So that was the first type of machine learning, which is the supervised. The second type is unsupervised. In unsupervised machine learning, we're not optimizing for a label such as fraudulent or not fraudulent. We're optimizing for finding patterns within the data in an unsupervised manner. So basically, um, sorry. So, an example of unsupervised learning is customer segmentation, where we don't have necessarily a label. So, we're not trying to label customers as fraudulent or not fraudulent. What we're trying to do is investigate the type of customers and the number of customers we have within certain categories. So, we can do a customer segmentation, treat it as an unsupervised learning problem. Understanding customer segments will help us like recommend the best solution for customers and improve the marketing effort and customer satisfaction. So think of the customer segmentation as random or machine learning model that takes as an input different features such as the transactional data, the frequency of transaction, how frequently does this person pay, or use their card, what type of amount do they spend, what is the category of their spending, are they mostly spending on food or fashion or whatever, what is their demographic data, age and gender and occupation and location, and what's their behavior data, do they take loans, do they repay the loans when they take them or not. So think if we use this as an input to our unsupervised learning problem, the output will be a grouping, a clustering that's based on those features. And the clustering that's based on those features, or the groups of cluster that are based on those features, can help us get insight into the customer preferences. How can we use those groups? We can use them in multiple use cases, such as targeted marketing. For example, if we want to market for a certain credit card, it may be more reasonable to market this for students, for people who are spending very low amounts per month and who would appreciate an extra source of income, but also be able to repay the amount they got. Um, Also, we can recommend like products again based on the segment characteristics. For example, if it's someone who just graduated, we may suggest a car loan or an auto loan, and so on. And we can also focus on customer retention. Like we can easily identify the customers that are not paying their loan and trying to retain them. That's an example of unsupervised learning problem. Back to supervised learning. As I said, we have some sort of label data that exists historically and we're trying to estimate. So, for example, here we have the default prediction problem. The default prediction problem is a problem where we predict whether the customer will be able to repay their loans or not. So the inputs to that, if we want to predict their behavior, we can use their historical loan data, whether they took loans in the past and paid it or not. Because if they did not pay loans in the past, it may be a strong probability that they will not pay their loans in the future. Also, do they repay on time? So with repayment, you have to pay monthly installment and they need to be on time. Do they repay on time or do they usually become late? What's their credit score? A credit score is a function of your salary and the type of loans or products that you have. What is their income level and employment status? So all of those features can get into predicting whether they're gonna pay or not. We can also take some data related to age, location, education, and etc. And also we can have financial behavior data such as the account balance, the transaction history, and so on. So having that, we can output one of two things. Either the customer will default, which means will not be able to pay the loans, or they will not default, which means they'll be able to pay the loans. And we can estimate the probability of default. And this is an example of a supervised machine learning problem. The use cases of this problem is loan approval. So when banks are trying to approve your loan, they run it through a similar model, which is a default prediction model. They predict whether you're gonna default or not. Credit scoring also uses, or credit scoring assesses your what we call your credit worthiness, which means like are you worth getting the money? Are you worth getting the loans? Will you be able to repay it back or not? And finally, we can use default prediction in risk management. So I know that I will have 20 customers who are not going to pay. Then I better compensate for that in interest rates in order to make sure I'm fully covered. So we covered traditional machine learning in the financial field, supervised and unsupervised. There is just a new domain in machine learning which is called generative AI. And generative AI is basically a class of algorithms that doesn't necessarily learn from historical data and doesn't necessarily learn patterns from current data. It does more generation than learning. So it generates based on the data that it saw. An example of generative AI model is Jan's variational autoencoders and transformer models such as GPT. Why would we use generative AI in fintech? Because it helps creating realistic financial simulations. It helps us simulate data and get synthetic data, and also improve our machine learning use cases and offering personalized financial services. I'll walk you over each one of those use cases in details. So for fraud detection, it's as simple as we can use generative AI in two ways. So generative AI is able to generate data with certain characteristics. So I can ask my model, the transformer model, to generate some fraudulent data, and it will be able to do that. And I can use this data in order to support my classification model. And I can also use generative AI to identify anomalies in the data. So if I give it all the data and ask it like what type of anomalies exist in the data, generative AI will be able, models such as GPT will be able to tell me what are the anomalies in the data. Also, I can use generative AI. I think we all at some point had interacted with GPT and talked with it, and GPT is proven quite successful in generating personalized financial advice. So if I'm a student, I have certain commitments such as housing and other things. It's very good at personalized financial advice. For example, if I know you are a student and I know your spending history and spending pattern, I can basically understand where the inefficiencies are in your spending history. And I can create, as a generative AI model, such as GPT, I can create a personalized financial advice for you. I can also, people use ChatGPT or generative AI to replace something like customer support chats. So, for example, or virtual advisors. So, for example, instead of hiring a customer support chat that answer very basic questions such as what is the number for me to get a loan and so on, um, basically what we can do is that we replace humans with AI, and it's pretty good at solving this problem. And as I said, I can have a virtual advisor. So when you go to the bank, you usually have an advising session with a bank teller who tells you like teller who tells you like you should be, for example, taking product X, Y, and Z because your salary is in the range of X, Y, and Z, and therefore it's important for you to take a product within this range. So generative AI can easily replace this pattern and can easily provide the virtual like advising capability. Right now, I'm done. I would like to take your questions and feedback if you have any. So if you already have question, Q&A. Okay. If you have any questions, please let me know or send them over the chat. Hi, Ahmed. Please go ahead.
Hello, do you hear me now?
I hear you now. Yeah.
You hear me?
Yeah, I can hear you, Ahmed.
Uh, Now I don't hear you. Okay, just please wave with your hand. If you hear me, okay. So thank you for the interesting webinar. I don't hear you, so I will pose the question and then turn back my mic on my speaker. So my question is about the people who work in fintech in this regard. I'm coming from a computer science background, and I'm very interested in machine learning and the generative AI, but I don't know how in banks or in fintech the people do this. Do they usually use tailored made software? Do they have some computer science experts? Do they have projects or something like that? Because this is what I'm interested in. If we have students and those students are computer science based and they want to do their projects or graduation projects in something related to fintech, where do they go to get this data set, or to train their models, or to know more about the customers, or see how to predict or generate um, uh, these tools, or these what you just described? This is my concern. Where do we go? So do you
Let
have
me tell
some
you something.
shared data set? Do the student come as internship and learn such stuff, or what? So and again, thank you for the interesting webinar. Now I'll switch back so I can hear your answer. Okay, thank you very much.
Okay, so to answer your question, Ahmed, um, basically what's happening is as follows. In banks, basically in almost all the banks I know, particularly in the Egyptian market, Yeah, they do hire people from a computer science background to handle problems such as default prediction, such as all the customer segmentation, all the problems that we're talking about. I worked previously in Crédit Agricole Bank as a data scientist, and I know that they're working on that. And there are also other banks that are doing the same things. There's also I think there is a data science team in every bank. International banks may be relying on external teams like outside the country. Um, for example, in Egypt, the central bank, the CIB, the Commercial International Bank, um, has this team. It has a data science team that's working on those problems, and they hire full-time positions. I'm not sure about internships. I haven't seen a lot of internships in this domain, but they definitely hire full-time positions. As for the financial data and trying to find the financial data to work on it in an independent project, this will be really tricky because no bank is allowed to share their customers' data. In fact, banks are very strict when it comes to customers' financial data because it's very sensitive. So, a good alternative to handle this problem is to be able to simulate the data or use generative AI or something like GPT to generate your own data, because banks do not share their users' data, because otherwise it's going to be extremely catastrophic. So and the banking data has a very well known distribution. For example, like on average there is the normal distribution of rich people and poor people, but that distribution is highly skewed because we have very rich people as compared to many like poor people. So the distribution is pretty known, like it's very known what is the distribution of financial data. So can you just go to CIB, Crédit Agricole, and ask them, please give me some data because I want to work on a project? That's not going to happen because this is very sensitive data to the bank and to the customers of the bank. What can happen instead is that you can simulate the data yourself and start experimenting with machine learning models. Please let me know if you have other questions. I hope I answered all your questions. Do you have any more questions? I think not. Okay, if you don't have any more questions, Yasmin, I think we can conclude.
Thank you so much, Mariam, for sharing your valuable insights today. I think, yes, we're not receiving any more questions. Yes. Okay. So thank you. And for our beloved attendees, we hope you found today's webinar useful and inspiring as well. And you managed to learn from what Mariam have taught us today. Be sure to stay connected on our social media platforms for future editions of the DSC monthly webinar series. Before we wrap up, I'd like to remind everyone to mark your calendars for the upcoming DSC MENA 2025, which is scheduled to be between the 10th and 12th of April. And please take the time to check the links to the conference website communicated in the chat box. And there is something exclusive with us today. And I just wanted to highlight that 1 second. But we have an exclusive discount for everyone today. We're excited to offer today's attendees an exclusive 50% discount on DSC MENA 2025 tickets. This special offer is valid starting now and ends this Friday. So simply use the promo code that will be shared in the chat box to secure your tickets at half of the price. So thank you so much everyone for attending today, and looking forward to see you on the DSC MENA 2025. Thank you so much, Mariam, for being with us today.
Thanks, Yasmin. Have a good day. Bye bye.
You have a great night ahead. Thank you.